This is Smart Investing with Mike Wren.
Securities and advisory service offered through KMS Financial Services.
This is Smart Investing with Michael J. Wren. With Michael's producer, Chris Martin. You can email us your questions. Go to smartinvestingshow.com to see how.
For I have the pride, the privilege, nay, the pleasure of introducing to you the one, the only.
This is Smart Investing with Mike Wren.
Well, hello again, everybody. We have finally another podcast ready for you. And just so you know, this is the podcast of The Smart Investing Show, where we, one, try to take the topic of investing, make it easier to understand. Two, get you good, relevant information on each and every show. And thirdly, we try to be somewhat entertaining so you can listen to the sucker. Because I've heard other financial shows, and they're virtually unlistenable. Just like food at some of the restaurants, food at the Chinese restaurants up and down Sprague and Spokane, inedible. Yeah, it's horrible. I mean, you have Chinese American food, and then you have Chinese American food cooked by somebody smoking a cigarette with tattoos that obviously doesn't care. Just like my mom when I was growing up. Hey, Mom, did you cook this? Because it tastes horrible enough that...
I hope this doesn't come off as racist, but I prefer when I hear in the kitchen yelling in Japanese or Chinese or Mexican or wherever I'm at. I prefer that, just that screaming in that, language, because then it tells me that's authentic.
Well, but it could be authentic, somebody under a methamphetamine fog, but you don't know because it's not English.
That's just gibberish.
Right.
That's what I call 7-Eleven-ish, because that's all I hear when I go down to that terrible 7-Eleven downtown.
Yeah,
where there was a stabbing, and it's the same store that I saw a guy dressed as a clown beating up a guy in crutches. It's an awful story.
Let me tell you, the audience, all 10 of you that listen to this podcast, let me tell you, you can't make this stuff up.
Oh no, that's the one that they do the little siren now to keep people away. There's a little, like a high-pitched siren outside.
Oh, I thought it was to keep the birds away.
It's to keep everyone away. That one scares me.
Speaking of 7-Eleven, this is actually a business story. In the newest or second newest business week that I read, 7-Eleven has started to have problems with their franchisees not following the rules. And you can probably guess the typical owner of a 7-Eleven, maybe in a very large city. Hello, would you like a free blueberry squishy with your pack of Marlboro cigarettes?
Are we talking about the people calling ice on them? Or?
Yes.
Yeah, I've heard about that.
Yeah.
7-Eleven
has their own enforcement agency. It's called... So if they don't toe the company line and put out the signage and run a nice ship-shaped store the way that 7-Eleven wants them, all of a sudden they get a visit.
So 7-Eleven's calling on 911 on a 311, or is that... Okay. Don't mess with my 7-Eleven. Leave them alone.
I had to smile at the ingenuity of that. Because typically, if you own a lot of rental houses, there's so many ways that you can, get screwed over by a bad renter. Everybody knows that, and it's just nice that the franchise owner has a little bit of power, that they just can't be railroaded. It's like, just a tender moment, with the holidays coming up.
Yeah, because that's a feel-good story right before Thanksgiving.
It is for a capitalist, yeah. Okay, I digress.
And you're pulling up your sleeve. I thought you were going to high-five me.
No. Oh, gosh. So anyway, on today's podcast, I've got a case study that I'm going to be talking about, and basically it's once again going to be trying to beat the crap out of the theory that doesn't have any thought behind it, which is that the whole world thinks that index investing is A, the thing that you should do, B, the area that you should... It's the benchmark that you should base all of your performance off of. It's what you should measure to. So it's the thing that you should do. And if you're not doing it, you should measure yourself to that index as a benchmark. And thirdly, people have been doing it so long that folks have forgot that there's anything else, especially the people in my industry. I think the people in my industry typically have more of a closed mind than an uninformed client off the street. Because at least the uninformed client off the street doesn't have a preset agenda in their head to try to do something wrong. They're just wanting to make more money. I think my industry oftentimes has a preset agenda in their head. How can I make money? Not for the client, but for myself. And then how can I do it without getting in trouble?
That was my first thought.
Yeah.
How can I do it without the client catching on?
Yeah. How can I make it seem reasonable, and how can I repeat that process over and over again every single day so I can get promoted in my company, maybe to management, so I don't have to do that stuff every day? And what is the quickest way that I can retire so that I don't have to sell my soul anymore? I think that might be the thought process. If you work at Merrill Lynch, UBS, I think that might be.
Once you get past like the age that I'm at, I think anything is, what can I sell my soul for just to take it easy for the rest of this time? I think I've gotten to that point.
Yeah, maybe people have got it wrong that it's the young people always, making the right or wrong choices. Maybe it's the old downtrodden person like you.
Like me.
I'm just kidding.
What can I do to make life easier? Sell my soul? Sure, what the heck? What do you got on you?
So anyway, and what also brings this up too is my partner in my office. He was commenting the other day that he was having to present his management style and process in a room with other managers because he runs a portion of, I think, probably some endowment fund. And he and I do the same thing. Not virtually the same thing, the same thing. We buy individual companies and we hold them and we look at them, individually, and we want to own them for the long haul. And he's very much a non-BS type of guy. This is how much non-BS. His prior life and job, he was writing technical manuals for people like Raytheon and Northrop Grumman for, guided missiles.
Oh.
Okay.
I was going to say how boring, but then I thought that's probably something you need to make sure that's correct too.
Yeah, exactly. So anyway, so he's got enough technical prowess behind him, I would say. He knows math and English. That's helpful.
One of the few that knows both.
Exactly.
Sweet.
Bilingual. He knows English and math.
That's the sweet spot.
And he was just livid about how stupid the other people were in the room, how they just didn't get anything. He says, I'm getting more like you every day, where they want to invest based on this damn pie chart that doesn't make any sense, where we want to own everything that's out there, even if it's going to suck amazingly. Even though we're going on an African safari, this is an analogy, even though you and I are going on an African safari.
All right.
If I was somebody in my industry and you're packing your suitcase, I'm helping you. And you come in from the room and you see a nice down jacket in your suitcase, folded perfectly, shoved to the corner. And you would say, what the hell is this down coat doing in here? We're going to Africa. And I'd say, well, I just want to cover all my bases just in case.
Wow.
Well, unless we're flying over a pole and could crash, and I'm in the midst of the crash that I could get from my seat to my luggage in the lower compartment, find my bag that didn't go off a glacial cliff, and get my coat out of there, that's a really good idea, Mike. See what I mean?
Yeah.
Completely useless, putting it in there because it looks good. That's the theory.
You'd probably hear me roll my eyes.
Yeah, well, you'd probably, if you were right, as soon as I turn my back, take the damn coat out.
Take the coat out.
Yeah.
And then call my wife and go, I can't go on this trip with Mike. He's crazy.
Yeah. I got to tell you, that's my industry. My industry, I don't even know what the hell people talk about anymore. You have these dog and pony shows where you can insert the name of damn near any company out there, and they trot out some economist, they trot out some money manager, and they start talking about the economic predictions of this, the economic predictions of that, how much the Fed is going to raise interest rates. Oh my gosh, isn't Donald Trump causing hell with tariffs? They go on ad nauseum, and then they throw all of this stuff at the wall, and then they'll say, and because all this stuff has been thrown off the wall, I mean, they kind of, isn't this a lot? And everybody starts, yeah, it's a lot. So if it's a lot to know, so I guess that we should be thinking about this and this and this, and then we want to invest in this asset allocation. Then they're talking about, shall we do just indexed investing, passive investing, where we just put the money in the index? I don't know. It sounds kind of bad if we put it all in there. Maybe we should try to tune it up a little bit with a little bit of active investments, with an exchange-traded fund over here or a mutual fund that specializes in this, so we can own some other, and we just don't want to own what's in the market. Maybe we want to own all alternative asset classes. Right when they say that, they have no idea what they're talking about. They're truly talking about owning, 3 of the 4 worst shopping mall real estate pieces probably in the United States. They're probably talking about owning agricultural farms in the U.S. and especially in other countries that don't have to follow general accepted accounting principles. Of course, if you invest in something, why would you want believable financial documents? It is alternative, so might as well just hang your ass out and just go for it.
Sweet.
Yeah, might as well be like Harvard. Let's invest in everything. We're smart. Okay? I think the definition, the only reason that you're listening to this podcast is you're kind of hoping that the word investment might have an equal sign to the right of it, and after that, it would say making money for yourself. Why else do you want to do this? We're not investing to save the world. We're not investing to help our neighbor. We're investing so we don't have to have our kids wipe our own butts. We are investing so we can be independent, so we can have financial security. I will have clients in the office, and if they've talked to too many people in my industry that like to talk about bucket, well, we want to make sure that we overfund the kids' college education, and then with whatever's left, we're going to do our own retirement account. And I say, stop. They say, stop. Let's not talk about all these little different accounts you want to have. Let's just cut to the chase. If I brought your kids in the office and kicked you out of the office and asked them one question, where they get one of 2 choices. Choice number 1, they get to go to college debt-free. Choice number 2, they never have to change their mom or dad's diaper. They're going to take choice number 2 every single time.
The thought in my head was, as long as you don't tell my parents I'm not going to college.
That too. That's a good indication of what my bedside manner's like. Because it's just blatant reality. You are talking with me to have some sort of financial security for the future, and you're only going to have financial security 2 ways or a combination of the 2. One of 2 ways or a combination of. 1, making enough money from your investments that you can live off the growth and the dividends and the interest. Or 2, having such a reduced lifestyle that you have to earn damn near nothing on your money to make it go. The second one was the favorite of people that grew up in the Great Depression. No matter how much money that they had, they lived on $2 a month. That's just what they did. It just is kind of their mannerisms. And it wouldn't matter how much I made for them or didn't make for them. It wouldn't matter how much security that they wanted or didn't want. It didn't matter how much aggressive. It didn't matter if they tripled their money in a company in a half hour, which is not going to happen, but it wouldn't have mattered. They live on $2 a month. That's just their mannerisms. So that's the combination. You have to make enough of your investments so the dividends and interest and principal growth can fund your income, maybe with a little bit of principal spending down, maybe not. Or you have to cram your lifestyle down and have everything paid for that you don't need much income for the time that you don't want to work anymore, want to work less, however you define retirement. Wouldn't you say that's the goal? Pretty simple goal. If you're managing money for an endowment fund, you are trying to grow that sum of money at a rate that exceeds the rate of expenditure of that entity, so the entity can for forever be there to grow in perpetuity. It's pretty simple. You
want that endowment to do really good so you can be well endowed later.
Yeah. Chris's double and triple entendre on a Friday.
In my head for 10 minutes.
Yeah. Dear Tyree, beware when Chris is drinking iced coffee.
You've never heard the well endowed? Come on.
I'm looking at Chris's cup. Bodacious Bean. Is that one of those independent places that serves coffee?
Not just a Maverick gas station.
Oh, okay. Yeah, I like their coffee. I was going to accuse you of being at some place that had scantily clad baristas, but you're not. You're at Maverick.
No,
they're just tattoo clad.
She's very tattoo clad. How did you know?
Is it the one down here?
Yeah.
Yeah.
you know the one I'm thinking of.
In quotation marks for the podcast, inside joke, wink, wink.
And she works every Friday morning. What?
So, let's get to this case study, shall we? Is that boring enough for you? So we know that we're actually doing work. Can you look at that
what?
paper?
There's well, barely. I've been going to get glasses last week.
Okay, don't say the people's name
No,
at the
I'm
top.
just saying,
I
can barely understand some of the words, and I see a lot of numbers. So it's English and math. And
okay,
me and your partner would not get along.
Okay, so Chris is our proof that I actually did work. Okay.
Yes.
What it is, a client came to me that was working with somebody else. They have $311,509.
Now wait, when you say a client came to you that was working so were they working with two people at the same time, or did they quit them and come to you?
The second one.
Okay.
Mm-hmm. Well, they're thinking of not investing the way that this other person was advising them.
Okay.
If you could call it advice, that's a really loose term.
Oh, okay. Fast and
Okay.
loose. Like when you say Gary Busey's a celebrity. Got it. Okay.
Exactly. But Gary Busey, what does he have? Awesome hair.
Awesome hair.
I'm ripping off that comedians in cars getting coffee with Seinfeld and Ricky Gervais. They drive by Gary Busey. Scientists have spent millions of dollars for 3 years on hair care products to style the hair correctly, yet they cannot copy Gary Busey's hairstyle, So, it's a couple. They're late middle-aged. They have $311,000. 69% of their money is in mutual funds. 31% is, guess what, in an annuity. Oh my gosh, we know it's going to be a good podcast now. So, there are 4 mutual funds, all in the Franklin Templeton Group, and the one annuity is from a company called AXA Equitable. AXA is a very, very large French insurance company, and you know the French. There you go, an annuity, and you add French to it. Unless we're investing in croissants, it's not going to look pretty at the end. So,
would you like to invest in this? Ha ha ha.
Yeah,
that's all I know.
Oui.
It's all the French I know.
Smoking a cigarette. Oui. We hate the American. So, Franklin Templeton. Let me start by saying, it's a really good mutual fund company. I just don't happen to like mutual funds so much if I have my wits about me. So those 4 mutual funds, this will tell you something. There's 4 of them. 49.3% of their money's in one of them. 0.2% of their money's in another one. So yeah, like $561. So $153,000 is in one of the funds. $561 is in another fund. $6,171 is in another one, so that's 2% of the portfolio, and then 18% or $56,000 is in another one. That's a weird distribution of money straight away, don't you think? I mean, of 311, 153 here, $500 there. What's with the 500? That doesn't 0.2%. I mean,
maybe that's what was left over from the other ones that they put in.
Okay,
you got 500 left.
Yeah. It's like, obviously, no one's watching. And then the other fund, 56,000. The annuity's got 95,000 in it. 10 years ago, they put 118 or 16 in that. So now it's down to 95 because they've been pulling out $375 a month living off of it, and there's like a 1.4% expense ratio on that sucker that you see the fees coming out of it. So here's the performance. The mutual fund that has the 150,000 has been averaging 4.8 per year. Wow. It's a very conservative fund, but it should be doing a touch better. That fund with $560 in it, it's been averaging 1.23%. This is since inception, and these people were working with this person for like a decade. Another mutual fund actually doing okay, the one with $6,000 in it, 11.45% per year. And this founding funds, I guess I didn't want to use the name, but I don't. they won't know the exact name. It's been averaging 1.83 per year. And the annuity, the computer says, has been losing 39/100% per year. So almost losing 0.4% per year. And I looked it up for a decade. Okay. And so I should probably put some sort of a disclaimer out there that this is for.
I was going to ask you earlier. Do I need to go back and edit that? I'm kind of
we don't need to edit it because I can think that because it's not a solicitation to buy or sell. Obviously, I wouldn't want people to own any of this stuff.
You know what? So, if you're laughing at something, I wouldn't go. I think that's you're actually wants me to buy that.
So I'm obvious. It's not a solicitation to buy, and how can I make sure it's not a solicitation to sell? I will say this, that this is happening for these folks in this certain time period that they own this stuff. So somebody that owned it in a different time period may have better performance. And who knows, these people may love this. I have a distinct feeling since they came to me that they don't, but they might just be feeling me out and not want to, not like my ideas at all.
I mean, here's my disclaimer. Are you these people? No? Then don't do anything.
Yeah. Exactly. The people that shall remain nameless. I see this all the time. So here's $311,000, 70% in funds, 30% in an annuity. Great. Okay. And they've been pulling money out of the annuity. It's been going down. That doesn't mean it's the worst thing in the world. There are some guarantees to it. That's what the compliance department would say, is that, there's tons of guarantees. And I haven't done all my due diligence on it, but here's what typically happens in this scenario with an annuity. If you don't get enough growth from the thing and you're taking money out, your principal's going to decline. The insurance company's going to say, yeah, that's your contract money, but there's benefit money, which it's money that if you leave it there with the insurance company, they're willing to treat it like you actually, quote unquote, have more money with them and pay you out this month. And of course, the principal's the walk away money is going to get eaten down to a point to where you're never going to walk away, to where all of a sudden you've kind of focused on the monthly check more than your principal that is quickly not existing anymore. It's kind of like the reverse of not paying attention to the price of a car, only paying attention to the monthly payment.
Okay.
This is kind of along those same lines.
This is a $100,000 car, but you're only going to be paying $100 a month. I'm in.
Forever.
I'm in.
Yeah.
I don't even care.
Yeah. And it's kind of the same focus. It's like, the principal, I don't want to focus on the principal. I want to focus on a check for life. Okay?
Got it.
Yeah. And that may be what these people want. Okay? But that's the only thing that an insurance product typically can offer somebody are some guarantees. They're looking for a product so they don't have to trust what I'm about to say. So they don't have to trust anybody. So they get an actual guarantee. That's what I get it. Like I said on another show or many shows, 90% of the people out there don't want a 401k. They want a pension. They want to know what the check is that they get every month. That's it. They don't want to have to make any high level decisions on their money because they typically make bad ones anyway based on emotion.
Oh, right.
Yeah.
No, or just non-education. I mean,
exactly.
At work, they have us going through a computer thing now that where we tell it what percentage that we want out of this and that. And before it was like, I would go to HR and I would say, I get this amount. Can you help me out with this?
You don't. Oh my gosh!
I'm not giving you my password.
What?
I've already had to change it from 123 to 456. So, but
mine's Krispy Kreme.
Is it?
Okay.
Mine's Chris Rocks, ROX. But I shouldn't be entrusted with any of this. I mean, I look at it and I'm like, I shouldn't be entrusted to say 1% or 2%. I don't know how much that is.
And this is coming from the producer wearing the amazing Spider-Man baseball.
Like that. I hate these flat brim things, though. These new kids wear.
Chris, you make me smile, man. I wish the podcast listeners could see the smile on your face when you're being very, very sincere when you're saying I shouldn't be entrusted.
Oh, no, I'm the first one to tell you I'm not the smartest one in the room, and if I ever am, you need to get out of that room.
So here's what's going on, is that these people are pulling $375 plus occasional lump sums from that annuity and eating the crap out of it, okay? And they're not pulling any money from the other $216,000. So they got $216,000 in funds where they're not pulling any income off of them. And if they were, they'd be going down too because they're not really making enough to hardly to support any income at all.
You think that money they're pulling out's for medicinal marijuana?
I have no idea.
Nah,
I didn't ask.
I'm wondering what they're spending it on. Now I'm curious.
Well, anyway, pulling out $375 a month on a $311,000 portfolio is not going to kill the portfolio. But you can tell that these average annual return rates are so low, except for the one fund averaging 11 per year. That's the only one that can handle income being taken out of it. The other ones are going to decline or have really, really minimal performance. So it ends up that these people are spending about $4,500 a year. Typically, they've been taking out some lump sums, and they're going to be probably closer to $5,500 or $6,000 a year. Okay?
Okay.
You know, somewhere in there. Not on average. It's lumpy, just like life is. Some years you're good with money. Some years everything in the house breaks and you got to bail somebody out of jail and you need more money.
Or are they getting hooked on the medicinal marijuana? I got to know. I got to know what they're pulling this out of.
Yeah. Okay, Chris is on a tangent.
Hooked on something?
Chris is on a tangent today, so I apologize. So, obviously, I don't invest the way that they are. So I have not met with these folks yet, but here's how I would invest the $311,000. Okay, I would put it all in individual companies, and right off the bat, I would start by taking $20,000 of the $311,000 and just leaving it in cash. Why? Well, because I already know that they're spending for sure $5,000, maybe closer to $6,000-$7,000 a year. So if I know that they're going to spend $5,000 next year, I don't want to do anything with that $5,000, like take risk with it. Okay. I also know that a year is such a short amount of time that I can't hope to earn any sort of interest that will help them. So the best thing that I can do is have their next year's income be absolutely secure with no risk at all. Cash. Okay. Second thing, and cash would be a money market with, government secured paper that's going to come due 30 days or less. Second thing, I know that the way that I invest is so radically different from what they've been doing that they're going to be uncomfortable with it. Even if they immediately, by some stroke of luck, were starting to make money with me the very first half hour of the day that we built a new portfolio, I know humanistically, no matter what happens, they're going to be uncomfortable. I know my limitations. I know how much I can reassure the typical human investor. So I throw another $10,000 in the money market to show them that money exceeds all of their past expenditures that they've ever spent in a year's time. So more than 2 years of income is in cash. So the principal fluctuation of their portfolio isn't going to affect their income at all. I've separated the two. The income that they're going to spend, no matter how much the market or their portfolio drops, that cash isn't going to drop. So we're not ever going to be forced in selling something at a loss or selling something, at least for the first 2 years or more. We're never going to be, for that time period, we're never going to be under pressure to sell something at a lower price than we bought it because we already set enough cash aside for that income. That's why I did that. It's a pure emotional move. If we invested it, we would probably make more money over time. But this, obviously, they're taking out income, and that is the one key that I want to plan for. They probably would take out more income if the portfolio that they currently have was earning more. They're not stupid. They see the money declining somewhat, and they're going to know that there's some sort of a guarantee with the annuity. But like most clients, they're not going to be well-versed in knowing all the minutiae and the details of what,
But that's not their job, so they shouldn't know
Yeah,
those
but
things.
I know that the person they're coming to me because the person dealing with them hasn't given them that information either.
Okay.
So here's another big topic, is that of this individual company portfolio that I built for them, having that much money in cash in the beginning, you can't get safer than that. That's their income. Also, the dividends from all of these different companies, and it's 1, 2, 3, 4, 20, we'll just call it 30 companies, probably 35. The combined dividends from those 35 companies in a 12-month time period is going to churn out $9,000. Let me say again, just the dividends that are being paid currently. They could go up, more than likely. They could go down, not as likely as the compliance department would like you to think. Some of the companies don't pay any dividend. There's a small little investment in there of Amazon of $3,000, just in my proposal. Just 1% of the portfolio, because Amazon is down, and if Amazon grows like it usually does, it will quickly be more than 1% of the portfolio. But it may not. I might be the biggest idiot in the world investing in Amazon at the exact wrong time where it goes down to zero from here forever. Either way could happen. I'm sure that you, the listener, can know what the realistic plan is. I think that's enough of a disclaimer. So Amazon doesn't pay a dividend. So some of the companies in here do pay a really good dividend. So when you average them all, that's $9,000. $9,000 that's 2.9%. So the dividend rate that's being paid by these companies already exceeds by a pretty good portion the money that these people are spending straight away. You see what I mean?
Mm-hmm.
They're not going to be used to getting these dividends. They're not going to know what the hell they are when they first get them. They're going to say, nobody's ever told us about dividends before. So that cash account that I'm starting with 20, if they weren't spending any money, it'd be worth $29,000 at the end of a year if the dividends don't change. But they're going to be spending some of it. So they're going to start with 20. They're going to take some income out, and they're going to find at the end of the year that money market bucket more than likely is bigger than when they started, even though they've been taking money out. That's going to blow their mind, typically.
Mm-hmm. How's he doing that? Did you listen to his podcast? I don't listen to his podcast.
Exactly. And here, I'm putting 10% of their money in the telecommunications industry, 2% in aerospace and defense, 21% in pharmaceuticals and drug companies, 20% in computer technology, a pretty big topic, high tech, 3% in robotics, 1% in retail, 3% in chemicals, 13% in financials, 5% in industrials, 3% in an oil company and energy, and 12% in food and tobacco. That's it.
I invest 100% of mine in scratchers at places that sell tobacco. Is that anywhere close to investing?
No, but it is close to reality for the rest of the world. So anyway, that's how Mike Wren invests. The types of companies, this is not a solicitation to buy or sell. This is just giving you an idea. I'm going to run down the list of companies, and we're going to use Chris as a measuring stick if he recognizes the name.
Okay.
The first company sounds like the company that you work for, but it's the computer version, Cisco.
Okay.
You heard of them?
Yeah.
Okay. Qualcomm.
Yes.
Verizon.
Yes.
Boeing.
Yes.
Abbott Labs.
Only because you've said something.
Okay.
I'm not sure what they do.
Okay, drug
Is
company.
it drug? Okay, drugs.
AbbVie,
No.
drug company. Johnson & Johnson.
Yes.
Merck.
Yes.
Pfizer.
Yes.
Sanofi,
No.
drug company. DXC Technology.
No.
Okay, it's a computer
I know
tech.
Run DMC. Is that what you said?
Almost.
Okay.
Hewlett-Packard Enterprises.
Yes.
Hewlett-Packard Incorporated.
Sure.
Intel.
Yes. It's inside.
Microsoft.
Yes.
Taiwan Semiconductor.
No.
Okay, you know who it is by the name. Texas Instruments.
Yes.
Okay,
Not
not
do the speak and spell.
yeah. Zebra Technologies you won't have heard of.
Nope.
ABB.
What
you won't
does
have
Zebra
heard.
do?
Yeah. Zebra, to give you an inkling, their largest customer is Amazon. They deal with a lot of automation and inventory control. ABB, it's a robotics company. Amazon, you've heard of them.
I have heard of them.
Probably, used to be two companies. It's one company now, Dow DuPont.
Okay.
You probably know both. Yeah. Bank America.
Sure.
Citigroup.
Yes.
MetLife with Snoopy,
With
right?
Snoopy.
Travelers with the umbrella.
Yes.
KKR, you won't have heard of.
WKRP.
Yeah. Now, Caterpillar.
Yes.
Cummins.
CUMM.
IN.
I've seen the name, but I can't tell you.
Diesel engines.
Oh, okay.
John Deere.
Yes.
Illinois Tool Works. Probably not.
No.
Parker Hannifin. Probably not.
No.
Royal Dutch Shell.
Paint?
Yeah. How about oil?
Okay.
Shell oil, yeah. Altria.
Yeah, that's the stuff that Jamie Lee Curtis eats. Keep her healthy. Regular.
It's Marlboro cigarettes.
Oh, okay.
You're close.
That's close.
B&G Foods you won't know. McDonald's you will.
Of course.
Philip Morris International you will.
Yes.
Starbucks I'm sure you've heard of.
Yeah.
That's it.
Oh, okay.
Okay, the reason I did that.
About
now, again,
70% maybe?
yeah, so let me tell you, because this podcast, because I'm speaking, I have to put tons of disclaimers out there. These companies, it's an example. It's not a solicitation to buy or sell. What I do is not for everybody, okay? And this proposal may change in time. But this is to give a person an idea that, especially if somebody's listening to this podcast that's not a client, what is scary about those companies? I would submit to you nothing. If won like $100 billion, Powerball, you could buy, a few of these companies on the list. Not too many; they're really big, but you could buy a few of them. What would be wrong with owning the whole entire company of Johnson & Johnson rather than investing in the index? The reason I don't like the indexes is because they were a solution to a problem that John Bogle devised, and the problem was when he had a bad taste in his mouth about my industry, which I get, and he figured out that a lot of the managers out there were inept enough and they charged so much that their performance was really subpar, that a person could fix that by investing in an index. Well, my submission to you is, why is all of a sudden the lowest hurdle out there you can do better than working with somebody that's inept and a crook? What solves that? How did the solution of that become the absolute panacea, heaven, Valhalla of the investment world, where now that's the thesis that everybody measures themselves to? A simple thesis is that these people have been doing so badly that you can simply do better than this. When the people doing badly aren't representative of everybody. They're representative of a big chunk of my industry, but it's not everybody. And also, why would you want to own a piece of everything out there to generate wealth when you know that real, true, huge wealth is generated? Look at Bill Gates, not a diversified portfolio. Microsoft, Michael Dell, just one company. Look at all these successful companies. Jeff Bezos, one thing. They did not get extraordinarily wealthy by doing what my industry tells them to do. They got extraordinarily wealthy by owning one business, having all of their eggs in one basket, and working the hell out of it. We obviously don't want to do that by putting all of your eggs in one basket, but I'm here to tell you, you for darn sure don't want to do what my industry's telling you to do, because if there's one of those two camps that for sure doesn't know how to make money, it's the second one. They're the ones that blew themselves up in 2008, don't forget. So what I try to do is the next best thing of you owning some real successful private business. I try to own pieces of really good businesses that are out there that you can have confidence in no matter what the economy is doing and no matter what you're reading on the news. Because to take a point, just to pull a company out of here, McDonald's. No matter what people are talking about in the news, no matter what Trump's doing or the tariffs or interest rates, you go to the drive-thru, there's going to be cars there, and that's probably a sign that it's profitable.
My first thought was, I heard if you go to a McDonald's in the morning, you can hear all those arguments. So,
yeah.
But you're still at McDonald's eating.
Yeah, so another final disclaimer, we've got to wrap this podcast up. It's not a solicitation to buy or sell, and it's an example of how I manage money, pure and simple, and it might not be for everybody. But it's sure as heck a lot different than usually what my industry is telling you to do, which I don't think is very constructive either. So anyway, that's pretty much it. We'll be back next time with another podcast. We try to do it weekly, but it ends up to be something a little bit less than weekly. Thanks for listening, and we'll be back again next time.
Any opinions expressed herein are given in good faith and are subject to change without notice and are correct only on the stated date of issue. Past performance is not always indicative of future results. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Security, financial instruments, or strategies mentioned may not be suitable for all investors. Prices, values, or income from any investment mentioned in this report may fall against the interest of the investor, and the investor may get back less than the amount invested. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation of particular securities, financial instruments, or strategies to you. Before acting on any recommendation on this material, you should consider whether it is suitable for your particular circumstances and, if necessary, seek professional advice.